Hello everyone and welcome to today's Mondac webinar in association with Nova Juris Legal, who will discuss how you can unlock ESG excellence and the knowledge you will need to navigate compliance challenges. My name is Dan Sampaio and I'm joined by a brilliant panel to take us through today's discussion. But before I hand over to Vanshika Kundra, who will be moderating today's webinar, a housekeeping item. You can submit questions to our panel by typing them into the questions pane of the toolbar on the right-hand side of your page. The panel will endeavour to answer as many questions as possible. It's now my pleasure to hand you over to Vanshika to begin. Thank you.
Thank you so much for the introduction, Dan. I would like to extend a very warm welcome to everybody who has joined our discussion today. It will surely be a very productive session, and I hope we all leave having learned something new and with a new perspective. So today we will be delving into the world of ESG, environment, social and governance, and its profound impact on fund management. While there has been a focus on shareholder interests, the post-pandemic landscape has sharpened our focus on stakeholder interests and community impact. 77% of CEOs in India have reported stakeholder demand for increased reporting and transparency on ESG metrics. For this reason, companies and funds which invest into these companies are heavily incorporating the tenets of ESG into their vision and mission documents. However, it will not be right of me to say that this is a recent shift. Incorporating ESG principles into fund management isn't new. It has been ingrained in company practices for years now. Various prestigious companies in India, such as Tata, have gained massive success due to their focus on climate, good governance, socially inclusive practices, and trust building. Furthermore, companies such as Havells and Godrej have featured on the Dow Jones Sustainability Index, which is used for assessing ESG performances since 2019. This doesn't come as a surprise, as in India, our very ethos revolves around togetherness, and there is great emphasis on incorporating best practices, which lies at the core of ESG, as positive impact is never limited to the contours of our nation alone. Apart from positive community impact, there is a clear connection between ESG-based approaches and the profitability and longevity of companies as well. 58% of studies which have been conducted internationally show that there is a positive impact between the growth of a company and the incorporation of ESG principles into a company. In this very pursuit of sustainable growth, we have seen a creation of a change of tracking, reporting, and measuring ESG metrics. The funds which invest in our private equity and venture capital funds today have created manifestos which revolve around ESG principles, which lead to these funds adopting ESG-based approaches as well, which then percolates into internal company practices. And during the course of our conversation, you would be astonished to know just how far-reaching the tenets of ESG are, being relevant across industries and not just companies that focus on manufacturing or who are supply chain heavy. Even many companies today which focus on tech and AI are incorporating these tenets into their internal practices for sustainable growth. One more factor which leads to ESG becoming so extremely relevant today is that prominent limited partners such as the large pension funds, insurance funds, international financial corporations, including various offshore players which invest into our funds today, are championing ESG, making it a guiding manifesto in selecting funds. Institutional Limited Partners Association and Bain conducted a study which states that investment policies of 70% of limited partners include an ESG-based approach. Furthermore, a dramatic 3/4 of LPs said that they would stop investing in products that do not align with ESG principles. It is heartening to witness so many big LPs advocating for ESG and driving meaningful change. This webinar aims to explore the transformative power of ESG and its powerful role in shaping fund management. Now, before we get into our panel discussion, before I get into my questions for the panel, I would like to briefly introduce our speakers for today, who will be giving you great practical insights on how to incorporate ESG into your fund management. Firstly, I would like to introduce Amitabh Srivastava, who is a partner at July Ventures LLP, who brings over 3 decades of diverse experience as a venture capitalist, angel investor, serial entrepreneur, and senior executive with MNCs. July Venture has part of their portfolio many companies which focus on financial inclusion, edutech, and energy conservation, and many more, making him a great addition to our panel. Then I would like to introduce Sharda Balaji, who is the founder of Novojuris Legal, who leads an innovative law firm excelling in corporate, private equity, technology, and cross-border transactions. Novojuris has led various funds in their process of sustainable investments by advising them on how to incorporate ESG into their charter documents and how funds can measure and evaluate these principles while making investment decisions and managing portfolios. Then I'd like to move on to Chetan, who is the head of finance at Stellis Venture Partners, who brings over 2 decades of expertise in venture capital, consulting, and accounting. With relationships with various LPs, Chetan will give great insight on the ESG manifesto of LPs and how these translate into the larger process of portfolio management. Most importantly, he will try to give you practical insights on the bigger picture of measurement, reporting, and tracking. Ambalika Gupta, who is the Vice President of Sustainability at Snowcap, which is a company that assists funds and portfolio companies track and report various energy metrics, ESG metrics, has over a decade of experience driving responsible business practices, and she spearheads the development and implementation of Snowcap's sustainability strategy. She has worked with various funds and companies and helped them in their reporting and tracking of ESG, and she'll give you wonderful insights on what exactly these KPIs are and how to assign weightages to them, how to measure, how to track, and so much other great advice. So now we would like to get into our discussion. I want to open the floor to our wonderful panel and get their great insights. But before that, I want to request our panelists to quickly give us a brief idea about their work, their interaction with the field of ESG, and anything they would like to highlight for our guests today. So Amitabh, if you could just hear from you first, please.
Yeah, sure. Thank you for the introduction, and thanks very much for inviting me with all these eminent people. July Ventures, we've been an early stage investor, mostly B2B enterprises on digital infrastructure, data play, and so on and so forth. We don't do any B2C hardware, manufacturing, chemistry, any of those things. We don't. We just do pure digital infrastructure and data play on the same. We are an operating VC, so we actually get involved with running of the company for the first 6 to 9 months. And if you talk about ESG, that's something that we know that early stage companies are not very equipped to kind of understand and or even have the time to understand, take part in it. So we kind of have taken it upon ourselves to hold hands with them. We are new as an investor to focus purely on, starting with a deep understanding of ESG and its principles. But as investors over the last 15 to 20 odd years, we've kind of always been very, very conscious of our responsibility towards the environment, towards the society in general, and good business practices and governance. But obviously, as we rise bigger and take on to Series A and beyond kind of investing, which is what we're doing in the second fund, we've become very, very conscious. And it's kind of coming together of our personal interest, the requirement of the regulator, and also the expectations of the investors. So we began, if that's your question, I can add more. Vanchika?
So we just wanted to know your intersection with the field of ESG and your work in it. We will be moving into our more detailed questions later about the vision and mission which you have thought of for your fund. So I will just open the floor to Sharda, if you can give us a short introduction about the work you and Novojuris have done in terms of sustainability and ESG. You are on mute.
Sorry. Thank you. In ESG, I have enjoyed working on creating the vision documents for the funds, the AMCs, considering the United Nations Principles of Responsible Investing, the UNPRI, the National Guidelines for Responsible Business Conduct, the NGRBC, prescribed by the Ministry of Corporate Affairs in India. Then there is BRSR, Business Responsibility and Sustainability Reporting, prescribed by SEBI, the Securities Exchange Board of India, and Global Reporting Initiatives, GRI, while formulating these policies, frameworks, and criteria for investment. So that's the kind of thing. The fun part is to build a tapestry from the fund's vision document to selection criteria for investments, to building the portfolios, policies, and measurement metrics to help these portfolios to report out to the fund, and which in turn will report to their LPs. So this cycle is so complete and impactful that it makes for an exciting area to focus on. That's what I love to do.
Thank you so much for your introduction. That was great. And we hope to discuss way more about this very vision, mission, and population of information that happens in our current finance ecosystem. Chetan, if we can please hear from you as well.
Yeah, hi, hello everyone. I'm Chetan from Stellaris Venture Partners. Thank you for inviting me to this webinar. We are an early stage venture capital fund, and at Stellaris, I head finance, investor reporting, and also responsible for compliance. On ESG, we have two requirements. One, we as a fund, we have global investors, LPs in our fund, so they have ESG reporting requirements from us. And when we invest in portfolio companies, we have few reporting and compliance expectations from the portfolio companies, which in turn we report to our LPs. So we have to bridge between two activities. One is help portfolio companies with the compliance on the ESG part, and also later on in report to our LPs. According to me, E&S compliance is more important rather as a business function also, because if something goes wrong, there is regulatory risk always. The reputational risk is bigger than any of these.
Okay, that's great. You actually gave me a lot of discussion points as well, Chetan, so thank you for that. We'll be getting into that in a bit. And Ambalika, if we could please hear from you as well about your work. I'm sure you have a lot to talk about, but we will get into it later as well. So please go ahead.
Hi, thank you so much. So I'll really keep it short and crisp. I'm Ambalika Gupta from Snowcap, and our sole purpose is to ensure that the ice caps stay ice caps. And I think we are really determined to demystify the ESG landscape across the length and breadth of the geographies that we operate in. And yeah, and we're bringing technology as a accelerator to this whole aspect of demystifying ESG. So looking forward to interesting panel discussion this afternoon. Thank you.
Thank you so much, all of you. It was great to get to know more about what is it that you do. Now we want to get into your thought process on this entire subject. So I have a lot of questions prepared for you. I'm sure we'll have a very engaging discussion. So from my introductory points and from what all of you just spoke briefly, I gather that right now ESG from a fund perspective is becoming highly relevant. Firstly, in the recent past, we used to think about it from a company's point of view. But now we are discussing about it from a fund's perspective. So Amitabh, when you are doing the vision and mission for a fund, which focuses on ESG practices, ESG principles, there are so many principles that one can take into account. There are so many KPIs, so many metrics. How exactly do you incorporate these principles into the internal practices of a fund and across investment decisions? How do you sort of envision this as a charter or a manifesto for your fund? Amitabh, you are on mute.
I was lecturing Sharda about being on mute, and I was on mute myself. Sorry about that. Now, so As I was saying, like I mentioned, we've been in early stage investing. We are kind of moving towards early growth and growth stage companies, and we see a lot of importance. It's better to get prepared for the future. I mean, as you grow in later stage companies, there are several requirements from investors and also new sort of regulatory requirements that come forth. And if you're not preparing in early stage, it becomes a lot of a problem. So there are very different ESG reporting standards. We've kind of chosen to align ourselves with just two, the BRSR for India and the GRI standards. Essentially, we put together a team. Like I said, we've got a checklist. We have a negative list. Put together some kind of an early stage rudimentary scoring system of our own, which obviously will refine as time progresses and as years go by, or as cycles of audits go by, we'll probably refine those. But we have a fairly good list. We've taken the help of a few consultants and others and spoken to a lot of friends and put that together. That's at the AMC level. But even at the portfolio level, it's very important to sort of sit down with them and actually help them, give them a list, checklist, and kind of identify at the time of doing the diligence on the company. We prepare sort of our what is called as a gap analysis, and we tell them that these are the things that you need to kind of focus upon, which our investors expect, and we also expect in conformance to the BSR and other reporting standards that we kind of put together. Yeah, I mean, essentially, we will look at various stages of investment process, both at the entry point or at the time of screening or while doing the due diligence, maybe even at the IC level, coming up with conditions precedent if the severity level is very, very high, to kind of put pressure on them to say, hey, you got to get this going as well. And we also take the inputs of our co-investors while identifying some of those. Yeah, I mean, essentially, I hope I have addressed your question.
Okay, thank you so much for that. That was very helpful. So now that you spoke about compliance from a portfolio level, that there are certain things which you help a company sort of help them to incorporate ESG into their internal practices. So Sharda, I would like to know from you, at the portfolio level, do you think ESG is just a compliance requirement? Essentially, is it just making sure that companies comply to relevant law and regulations, or is it something bigger? And is there any history to this? Has it evolved with law or something else? And why do you think it has become so relevant today? So if you could just shed some light on that.
Surely. So it's a compliance plus plus. In terms of history, we've had Companies Act in India, which was mandated in 1988 on disclosures in the Board of Directors reports such as energy conservation, technology absorption. And there was a list of 21 industries, largely manufacturing. They were mandated to report greater detail, such as fuel consumption, power generation through diesel generators, measures taken for energy conservation, impact on the measures taken for reduction of consumption. Additionally, there has been an impetus since 1988 on technology absorption, adaptation of these newer technology, innovation, etc. The benefits of product innovation in order to conserve energy. Was this technology imported, for example? Are some of the disclosures mandatorily required? Now it's sort of become a check in the box. You can call this compliance because disclosures are mandatory, and I sincerely wish that there's a back-end measurement whether these companies could have done better, or benchmarking these metrics with certain industries. Not a feedback, I mean, somewhat like a feedback loop which could have been completed. You do this much, the industry per se is doing this much, or the benchmark itself becomes a little bigger, better. That would be really nice, is what I feel. And it certainly would be great if there's a consolidated report made available on these disclosures over the years and strides that India has taken over the last 30 years. Your other question is on governance, which has taken a center stage, especially with lapses in some startups due to internal checkpoints and processes not being robust. The law is in place for this. Yeah, it is the process and procedures which can proactively arrest these lapses which is missing. For example, simple thing like, are there joint signatories for operating a bank account? Simple measure, right? And when vendor selection process and ensuring that there's a lifespan that a vendor can work with a company. Good quality board members who can spend quality time through going through the businesses of the company, nurturing good practices, quarterly financial reporting to the board, and should there be delays, even with a quarter, right? The board proactively checking what can be done but better to fixing these issues that delays the reportings. Can fraud and misconduct and negligence be detected much faster is a question that the board could consciously evaluate. So all of this makes ESG much, much bigger than compliance to applicable laws.
Okay, thank you so much for that.
Can I just add to, Sharda, thank you for that. It's really helpful. One of the things that I keep hearing from the skeptics is about the greenwashing per se. So I was we sat down and we kind of analyzed some of this, and we thought that how about linking, and I'd like the other panelists to also respond to this in their own time. How about linking the ESG costs, that you kind of incur to the business results, in the sense that either there's an increase in the market access, or there's a reduction in cost somewhere, or access to new kind of capital if you've got as a result of your good practices and so on and so forth. How is it possible to kind of link the two? Your business KPIs, so your cost to the business KPIs, their impact on the business KPIs. Any inputs on that would be welcome. Thanks.
Is there anyone?
I have a point on that, and I'll get back to this in a bit, Amita.
Okay. Is there anyone else who would like to respond to that? As of now.
Yeah, can I just quickly add in, Amita? Absolutely possible to basically link your ESG performance to business metrics. I
mean the cost to a business KPI. Yeah.
Yes. So let's say if a business is taking a energy efficiency project, right? So it's directly impacting your P&L with the reduction. Now the break even in the investment that you are undertaking, or the capex that you have undertaken in order to install green energy system, and that is how you kind of compute the business reduction in the cost, but also the value generated over a period of time. If you kind of top it up with a carbon tax, which is not definitely mandatory in India, but in other parts of Europe and US, it just makes a whole business case as in why businesses should be moving into much more sustainable practices. So just a quick one there. Right.
Thank you so much for that response, Ambalika. So now that we have spoken about, we have sort of set the context about how, ESG is relevant, how these are incorporated into funds as well. But funds today, as was mentioned during our introductory conversation, are also guided by the manifestos of these limited partners as well, who invest into our funds today. So Chetan, I want to know from you, what is the LP ask when it comes to ESG? I'm sure this ask must differ a lot as per the sector which your fund invests into and the region which your fund is in. But being sector agnostic, especially as you mentioned, how do we sort of narrow it down, and how do we sort of align our internal vision to what the LPs ask of us? If you could just shed some light on that.
Sure. So we are an early stage investor. We get in very early into the companies, and like you mentioned, we are sector agnostic. So what LPs ask is what are the policies which the fund has to follow? What is the manager required to do as a invested in our fund? Reporting requirements, the responsibilities, and the organization. What the manager should follow to make sure all the reporting and compliance objectives are met. Third is the E&S system management and periodic reporting. So which sectors can we invest? What can we do? What we should not do? What is the tolerable limit? How should we report? if there is something which is going wrong, is it curable, when to report, and how do we manage our portfolio companies and help them to comply with all these requirements. This is the basic ask from all the LPs.
Okay, so when they ask this of you, is there any sort of international standard or set of KPIs which they give to you to follow as a guiding principle, or is that sort of an internal policy which you have to create?
Yeah, see, most of us are guided by the IFC performance standards and the guidelines. That is like a standard where IFC has put in a lot of effort and which is globally accepted by most of the LPs. And most of the advisors and consultants also understand this. The other and large investors are also comfortable with that. So we are guided by the IFC guidelines and performance standards, and we follow that.
Okay, great. So now when we understand what the ask is, we can move a little bit towards our investment and transaction process. Everyone here has been involved with that greatly in their years of experience in the investment ecosystem. So we would really like to know how the principles of ESG get incorporated in these investment decisions. If there's different stages of investment. When I say, I mean there's pre-investment stage, which means the DD stage, during the investment, and after as well, especially in terms of tracking and reporting and ensuring that companies are making sure that whatever you expect of them as an investor in terms of ESG, they are complying with, and they have measurable reports to prove that they are complying with it. So Sharda, I would like to know from you, especially with your experience in investments um, and due diligence, what are the changes we have seen in due diligence checklists lately? Like with the increased importance which is being given to ESG principles, have you seen any differences between the DD checklists that were probably sent out a few years ago and the ones which are in use now? And what are the main aspects with relation to ESG in these checklists?
Surely. So at Novo Juris, we largely focus on investments into tech and tech-enabled businesses, fintech, health tech, edutech, medtech, AI, big data, e-commerce, apps. So many more, right? The impact of environment, the E of ESG, is much lesser as compared to manufacturing companies, though the due diligence checklist still checks compliance to environmental laws, such as air, water, disposing of electronic waste, etc. That has not changed. There are so many laws that even a small software company has to comply with, about 150 to 200 legislations. About 18 legislations on labor laws itself, Equal Pay, Wages Act, Social Security, such as Provident Fund, Employee State Insurance, which are all very important. You have Apprentices Act, for example. The department has now actively seeking information on whether the companies are compliant with this or not. And some of these small tech companies, they have not been actively complying with it, right? That is more like the social angle also to this. Now, ESG is not to be confused with impact investing. While there is impact and measured impact, ESG is much broader than impact investing. So the social cause is much wider, not just shareholders, but climate, environment, customers, vendors, employees. Again, when you spoke about Tata's, the conglomerate that I really admire is their ability to create the social angle, very purpose-led on carbon and dust emissions, biodiversity, circular economy, running through its entire supply chain, including how they choose their vendors, and if those vendors are following the ESG principles, which has that percolating effect of social impact. I believe the social part is vision and vision-led, policies-led first, and then they weave into compliance, equal pay, diversity, inclusiveness, no gender or race bias will eventually get into the compliance. But they are, the tones that are at the top for being a vision-led and a policy-led. On your question on reporting, Ambalika is the right person to discuss on reporting. And I think she will be covering the reporting through the different stages of company, early, growth, late, mature companies.
Sure. And one follow-up question to that actually, Shada. So when we, as a lawyer who is doing a due diligence, as a fund who is investing into a company, is there anything, should my expectations change when it, in terms of if I'm investing into an early stage company or a late stage company? Should my basic DD checklist change, or can you just point out what are the key factors that have to be there irrespective of the stage of the companies? Just wanted to know your.
So it really depends on the business of the company, and it might be early stage, but very closely associated with, say, energy consumption. Then it becomes more relevant that you go into ESG factors of energy consumption itself. So one is the business itself, and as you grow along the stage, maybe and as the business keeps growing, there will be several other factors of social and governance that also comes into picture.
Okay, thank you so much. And as you rightly pointed us into the direction of reporting, measuring, and tracking, I think Ambalika is the best person to give us more information on that, because this is something which is not very talked about, not clearly talked about, and we would love to get your insight on this. So I understand that Snowcap provides a great product which helps funds and companies track, measure, and report on various ESG metrics. You have various questionnaires, various tools available on your platform to help companies and funds achieve this. However, one thing which is interesting is that you are able to provide weightages to these different metrics as well. So if you can shed some light on how exactly you report or measure, and especially how do you assign weightage to each KPI? How do you decide what is more important than the other?
Yeah, so to begin with, how do we assign weightages? So we have our internal methodology to the practice. We've been in the space and we've scanned the landscape about different ESG ratings, agencies, and the confusion that surrounds every the agency's methodology. But if you see fundamentally, while ESG ratings, the methodology is different from that of a S&P to Sustainalytics. It's fundamentally different. But the foundation is still in the fact that we all are concerned about the data quality, consistency of the reporting, transparency of the information, frequency, the source of the information, and then there are some other active moving items. So how are you being spoken of in the public social media space? What are the regulations that are on the horizon for your industry and sector? Cultural nuances are a key item. We all spoke a lot about S, but if you look at Islamic finance as a component, right, and the fact, S and the diversity part of it, inclusivity for an LGBTQ community is a little reserved topic of discussion there. And we have to give due credit to those kind of cultural and, finance practices that are out there. So that is what we do at Snowcap. Of course, we are built on the foundation that each or any other framework in the market exists on, but we bring in the cultural nuances, regional specifications to the geography that we operate in. And that is how we do our weightage allocation, because we understand the industry, we understand the risk. We also take into consideration when we design and when we allocate the weightages, the risk that is indicated in a global, let's say, slavery report, right? What is the risk identified for the country? What is the risk identified for the sector? But interestingly, we definitely take into consideration the fact that slavery is not just bonded labor, it's also human trafficking, right? So to what an extent you discount certain aspects and you do not take them up as is something that we internally as a team and a team of experts take into consideration with that weightage allocation. Your second question, Vanshika, was, sorry, if you can.
Yeah, so
the
my
reporting aspect.
Yeah, my second question, I'll just repeat. Firstly, I want to know about the weightages and the measurement tracking, how you do that. Thank you for your great explanation on that. Secondly, I wanted to know in terms of reporting, Can you just tell us very briefly that from a fund perspective versus a company perspective, what exactly do you report? Who do you report to, and what, for example, like funds would want to report to their investors, right? So what exactly do you report in those terms, and what do companies need to keep track of? If you can just tell us briefly about these two aspects.
Sure. So as we discuss this further, we need to understand that any fund operates with three kinds of investment strategy. They either invest into companies which have high ESG performance, so they know what they are getting into, or they invest into companies where they see a scope or a value add that they can bring to the table when it comes to ESG performance. And third aspect is where they are solution driven. So they are basically investing into businesses that are more specifically designed for catering to any E or S solution, right? Now, when that is an investment strategy, and it has to be one of these three or a combination of these three, when a fund starts investing in, we work with them to understand what the components are, what is the information their LPs are seeking. Now, Chetan basically mentioned about IFC and how IFC is an acceptable framework. Yes, there are 8 principles. One of the principle is pertaining to health and safety, right? So while for a fund, let's say number of incidents and accidents would be a key KPI, right? But from a company perspective, it's not just number of accidents and incidents, but also the penalties or payouts as in compensation they have to do. Now, when you so for a fund, while that's a good piece of information to go back and report, it is important to demystify or kind of deep dive from an accident incident rate into the loss of man hours and the compensation and payouts to add more value. Because as much as I've been in this space, the whole idea of sustainability is that sustainability means profitable business. So how do you de-risk your business while being sustainable is the ideology we operate with. And these are some key KPIs. Similarly, let's say SFDR, a lot of funds in Europe adhere to SFDR. Now SFDR want them to report on to their investments, and basically we are looking into financed emissions here. But if you're not asking that information about scope 1, 2, and 3 from your portfolio, you cannot report it back to your LPs as per the requirement. So while for a fund, I think they still need a very broad category of information to work with LPs and report back. I think more value add has to happen for the portfolio companies. They really need to see that if they do their scope 1 or scope 2 compute, it's not just a reporting exercise, but the fact that they see an opportunity to bring best operational efficiencies practices for reduction and save money, which gives them a longer runway to kind of go, right? So that's how this KPIs are basically designed. When we work, we create specific for the funds and their requirements of LP, whether that's IFC, SFDR, UNPRI, ADB requirements, and then the whole value add perspective for a portfolio company is the main crux of working with any fund.
Okay. Thank you so much for that, Ambalika. I really got to learn. Yes.
Sorry, Vanchika, if I may add on, just to add on to what Ambalika and Amitabh had mentioned earlier, as a compliance manager at the fund, it becomes very difficult for us to identify what the risk levels are. We have some metrics, so we don't want to overdo things, but also at the same time, we want the right things to be reported as well. So the risk grading is very, very important, and especially in early stage companies. They think that is an added cost, but rightly so. As a founder, you want to concentrate on the bigger things, but this also is equally important as running your operations and financial reporting. So that's what we try to make it a system which it incorporates into your normal reporting cycle. What we ensure is all compliance requirements are done, not only as a checklist, but also to make sure that the business runs smoothly.
Yeah, thank you for that. That's great. Actually, just a follow-up question to that. Firstly, I would like to hear from Chetan and Amitabh on this. Then, if the two panelists have something to add. But my basic question is, as you mentioned about early stage companies. Now, these early stage companies usually have a limitation of resources. And certain ESG compliances require a lot of funds, they require resources, and they require time, which many of these early stage companies probably do not have the luxury to spare. So how do early stage companies with limited resources achieve this ESG compliance, if I can call it? What is it that they should focus on, and what are, as you said, what are the right things to report for companies which have very limited funds? What from a company perspective, and even like from a fund perspective, how can you sort of, as you mentioned, handhold them through the process? If you can just shed some insight on that.
Chetan, why don't you take it from a overall perspective of from a compliance perspective, and I'll try and add some from the philosophical perspective on this.
Yeah, sure, Vanchika. The first important thing, like I mentioned, is to educate the founder and the company on why are we doing this? What is the requirement? It should not be like it is just a requirement from the investor. It's a check the box. You just take some things and report it to them. That's not the case. Most of the things which we ask from the companies or our LPs ask is anyways required, even if there was no ESG policy, labor law compliances, safety. All those things are anyways a requirement from a business perspective, right? Even if I don't put those clauses in the E&S checklist or in the documents, they have to comply with those. So that is very important. And later on, they may not have resources. That is where we step in. For most of our portfolio companies, we handhold them. Not that we have also been educated over a period of time. Our investors told that in the initial years that this is how this has to be done. We attend training programs. We also encourage our portfolio companies to attend training programs which are hosted by IFC, CDC, or any of those large investors. And later on, if few things, there may be few gaps. We identify which are critical. Those can be fixed over a period of time, but those which are really critical, like if you have like having a POSH policy, labor law compliance, anything like that, fire policy, all those things, those are a given. Even if you have 2 employees or 1 employee, 100 employees, they are a must on day 0. So there we have templates which we have developed. We don't want our portfolio companies or early stage companies to spend money, get a consultant and do it. The basic templates we share with them, and as they grow, they also understand, and as the business grows, they build on it and take it on from there.
Thank you, Chetan. I think so. I mean, as people who've always also been entrepreneurs ourselves over the last 20-25 years, this is something which is absolutely a must, and we've seen the advantages from a sustainability and longevity perspective of any business. Conformance to this is very, very important. And I've also sort of tried, like I was mentioning earlier, about how do we make sure that there is some measurability which can be verified. So linking it to your business KPI is something that I kind of focus on, and I'll work with the founders to actually kind of look at how do you arrive at, how do you say that I got this extra business as a result of my policies, or I was able to cut costs, or I was able to raise capital from a source that I wasn't able to tap into earlier, and so on and so forth. So I mean, that's because ESG could mean different things to different people. Yeah, I mean, so cut pasting somebody else's ESG policy onto your business could be a serious problem, because you will either end up having too many things to go through, or so you got to work with the founders to actually say this is relevant to your business, and from a end IRR perspective to my investors, I expect you to do X, Y, Z. I mean, that's the kind of discussion that I would start with, put it into the shareholders agreement, and then obviously do an annual audit. And I have to work along with my co-investors, no doubt, because I have to take them along in order to get the buy-in overall. Just from a philosophical perspective, these are the small things that I would kind of focus on in addition to this.
So also, Amitabh, just one more comment from my side. While cost to KPI becomes very difficult to measure or to fathom in very early in the cycle, for later stage companies, they will have the resource, they will understand it, but in very early stage becomes very difficult to measure those.
No, absolutely. But I think the consciousness needs to come at an earlier stage. When you get to the later stage, your mind is already, if you start in the later stage, it becomes really hard.
Completely agree. Yes.
Thank you so much for your insight. Now I want to open this question to Shada and Ambalika as well. What do you think is the golden criteria for such early stage companies? And how do you make sure that, especially in the post-investment process, how do companies remain compliant? What do you track? How do you sort of oversee and ensure that there are enough protections in place? Ambalika, if you want to give us some perspective about what you think is golden criteria for founders of early stage companies.
Sure. So, like Amitabh and Chetan both emphasized about it, right? Your license to operate, just getting the hygiene of setting up a business and keeping it up. That's critical. That is critical. So as soon as you get your license to operate and then you get it out of the way, it is basically the commitment of the founders to continue on this journey that I think funds should evaluate them for. Now, early stage companies, they lack resources, they lack capabilities, they do not have right people inside, they can't hire it, they see it as an added cost. And the whole idea for them or whole idea is not to penalize them for this inadequacy in their operations, but the idea is how do you incentivize and motivate them? Where do you bring for them the delta when it comes to growing business? So let's say, can you do a brand positioning around your packaging if you are into, if you're using green packaging? That is the reason why a founder would have his commitment and would continue. Nobody gets that perfect on day one. So you have a policy, great. It shows your commitment. Now, as a professional in this space, having a policy is great. But if there are targets, if there is a commitment associated in the policy with a timeline for reduction or improvement, if there is a consistent transparency about we just reworked our policy, these kind of aspects will only, so every step counts, right? So right from a refined version of a policy to identifying or nominating a person or a resource internally to execute follow-up, to have a small team to do quarterly reviews. And it's okay if you're not publishing your information out there in the public space to consume, but as long as you're maintaining that transparency with your fund investors and your other partners, that's critical. So the whole idea in being in the space is that I don't personally believe in penalizing or blacklisting companies or suppliers or founders. The whole idea is how do you incentivize them, you handhold them, and that is where most of the funds are actually actively playing a role. So they are not just providing that support from an awareness perspective, they are also walking the talk with them. So they are happy to bring in relevant people to the table for a just short discussion, how things add value. And that's the job of an investor, right? You bring the right contacts to the table. Yeah.
Exactly. Thank you so much. Shada, do you have any comment on that? If you can just shed light.
I think Ambalika covered it really, really well. I don't have an additional point on that.
Okay, sure. So moving on to one aspect which we think we should talk about today because this is a little bit left out at times. We talk about E&S from a regulatory standpoint. We focus on, we have certain benchmarks which we can track them against. There are many points which we can compare and we can ensure, okay, a company is compliant to this. So we are done. We can understand that the company is compliant. But in terms of softer aspects, do you, Shada, have any red flags that investors should look out for while investing into a company?
Surely. So when Vanshika and I were curating this webinar, this was the most important topic that we wanted to cover. There is so much to address on this and maybe a full-length webinar on it. But for now, let me do about 10 points. Governance is applicable to all companies, micro, small, medium, large, listed, worldwide, MNCs, all, right? And governance is also the secret sauce for sustainability of the companies for generations to come. In fact, in India, family generation wealth is still new as compared to Europe. And I think with ESG, and therefore sustainability and therefore wealth creation, I think it's all coming in very, very beautifully. The founders and directors are the conscience keepers, and there is a bigger responsibility on them as compared to employees and shareholders who are also responsible. Now, founders and directors are also responsible for coming up with this Lakshman Rekha for the zero tolerance line. And these are my thoughts. In putting together a code of conduct, expected behavior, ethical standards, check what is being incentivized. Then setting up clear internal controls, policy and implementation, transparency, accountability, accurate and timely financial reporting, and with the current digitization of government departments, aspects such as GST and tax reconciliation is easier. And maybe implement with AI ML led behavioral assessment of founders, KMP and directors. In fact, one of July's portfolio company called Confirm You has a great product around it. Then the whistleblower policy is another I can think of for reporting fraud, misconduct, unethical behavior. And once reported, taking appropriate action, protecting the whistleblower, etc., is also important. And after this comes the regular training and education at the time of employee onboarding and at regular intervals. Even board members have to be educated, including refresher courses. Raising awareness on maintaining integrity is a continuous process, right? Then independent audits, periodical audits on financial systems, compliance, internal controls, vendor audits, helping in bringing in best known methods of doing business. Then transparent financial reporting, well, that's the basis of doing business, isn't it? Related party transactions, cash flow, and conciliation, and check if that matches with the monthly MIS. Segregation of duties is another. No individual should have full control, make a checker process, separation of duties such as authorization, recording, and custody of assets to minimize risk and fraudulent activities. I think Ambalika's will have a longer questionnaire which kind of helps this. The background verification of vendors and employees, somewhere the background verification of employees and their past history, even startups should do it. Somewhere that's kind of a mess. The key management personnel hiring and firing should be monitored by the board, especially in smaller funded companies, the early stage funds, etc. 10 points, but one more. Independent directors and their continuous learning, independent board oversight. These are some of the steps that I can think of in the given time that you've given me.
Thank you so much. That was really helpful. I'm sure all the young founders and CEOs who are part of our session today will really take away from all this discussion. So just in the form, now that we're nearing the end of our session, in the form of just brief concluding remarks, if all of you could just give some advice, as experienced professionals to young founders or newer funds or funds who are just trying to incorporate ESG into their vision and mission. If you can just give us some advice which they can take away from this session, that would be great. We'll start with you, Amitabh.
Sure. Couple of things. I've heard people talk about in the investor community, people talk about this is an ESG deal. What's an ESG deal? I mean, ESG is not a sector. If that was the case, then Tesla wouldn't have scored half of Philip Morris in the US in terms of rating. Okay, so ESG is not a sector. It's not a deal. Ultimately, it's about impact, and impact is like the end destination of a vehicle. Yeah, whereas ESG is the vehicle. Both are important.
Nice.
Thank you so much for that. And thank you so much for being part of the session today. Thank you for all your advice. Chetan, if we can please hear from you.
Yeah, I think earlier the better. Start from day zero. It becomes easier to incorporate and take it further as the organization grows bigger. ESG, like I mentioned earlier, governance issues will have reputational risk which can't be undone. forget about the financial impact. So these are the two things which I would like to emphasize on.
Thank you so much again to you as well. Ambalika, if you can please hear from me.
I think I definitely resonate with what Chetan said. Earlier, the better. You can fail and then you can get back at it, quicker. And just because this can be an overwhelming landscape of too many frameworks, regulations, KPIs, start with SDGs. Let's keep it simple. It's only up to 2030. Take what you can. Let's run with that. So, and along the way, just look around, right? From your peer benchmarks to best in industries to those starting off. It's nothing to be scared of. So, yes, SDGs are a good starting point.
Thank you so much for that. And Shada,
To me, ESG should be driven with a tone set at the top. A lot of things will come in place once there is that acceptance and there is a tone set at the top. The second is, when in doubt, disclose. That would be the best way to approach ESG, I believe.
thank you so much. To quickly summarize what we discussed today, from what the popular sort of perspective today is that ESG is something very new. It is something we have to do. It is something we have to incorporate now. But that is not true. These basic principles have been in the core of all our businesses for years now. Practice such as social inclusion, such as positive impact, such as protection of the climate and environment. Many companies have incorporated that and have gained massive success by doing so. So this is not something, as Ambalika said, to be scared of. This is not something to be intimidated by. I understand we have so many standards, so many frameworks, but we can just stick to the simple ones. And from what I gather, the core factors which we need to stick to is transparency and honesty and reporting. Even if there are flaws, even if there are gaps, these gaps can be bridged by cooperation in the entire financial ecosystem. But as long as you're honest, we can work towards positive impact. Yes.
So there is this question that Saurabh is asking, how ESG is different from CSR, and put highlights on common points. If I can take that up. So Saurabh, CSR is more from the Companies Act perspective, a sized company giving back to the society on specific sectors, right? And that is more like making the organization responsible for some social cause. Whereas ESG is a lot bigger. It is the way the business is done. The entire business is done, right? So from that perspective, CSR is sort of a subset of a ESG is how I would like to look at. Ambalika, what's your point?
So I'll quickly add on to that. While CSR has a CSR Act, it's guided by a CSR Act, percentage of your revenue. The foundation is you cannot invest or you cannot undertake any activity that benefits your business. And that's a very context setting for India, right? While in ESG, you can work with your suppliers who are directly going to benefit your business. You can engage with your suppliers and push them to undertake renewable energy projects or better disclosures, better labor policies, so that your business does not get impacted with a reputational risk, with a compliance risk, or so on and so forth. So ESG and CSR are fundamentally different from that perspective, while they are still both, kind of regulated to an extent that you need to disclose what you've done as a business. However, in the West, CSR is corporate sustainable reporting, which means it is ESG. Right, so it was really interesting because when I was working in UK and I was like, okay, but CSR, how isn't that supposed to be philanthropic? Isn't that supposed to be something giving back to community? But in the West, the whole ideology of CSR is corporate social responsibility. Corporate sustainability reporting, which is like you can talk about ESG, you can work with your employees, you can actually invest into employee well-being, and that can be part of your corporate sustainable reporting practice. So it is a little different when we look at it from a regional perspective, but in context to India, sort of, they are fundamentally different from this perspective that you cannot invest into any activity that benefits your business. but you can invest into any activity that is more for a social cause, environmental cause, and it's only ENS. There is no G when you look at CSR. I mean, governance committee, of course, you need something to regulate it, but you cannot invest into your governance practices. So yeah.
So the early stage companies can have something called people in the early stage companies can have something called as PSR, personal social responsibility. So they don't have an obligation for a corporate social responsibility. The other thing that I just quickly want to point out, for financial reporting, you have different GAAP requirements, GAAP, etc. Yeah. But from the perspective of measuring the overall sustainability of an organization, there are different frameworks. All those frameworks have come out of the whole philosophy of ESG. So ESG is not something which is, I mean, it'll evolve, it'll come up, but there'll be different standards. And there are US GAAP, there's India GAAP. So for financial reporting, similarly, you have a framework for this. I don't know if this answers their question in some ways.
Thank you so much. And Saurabh, I hope that answers your question. Thank you so much for that brilliant question. And as Amitabh just said, ESG is a philosophy. It's constantly evolving. It's constantly getting incorporated into our financial ecosystem. And I really hope that our panelists and our entire discussion today was helpful for you. It gave you some practical advice about how to incorporate the same into your investment practices. And I would like to thank the panelists. Thank you so much for taking time out of your busy schedules to be a part of this discussion. Thank you for all the knowledge that you have shared. We are really, really grateful for the same. And with that, unless there are any other questions, I will close the session now. Thank you so much, everybody, for joining. I really thank you for your time. Thank you so much.
Thank you.
Thank you so much. It was a pleasure.